Welcome, everyone, to the Deep Dive. We're here to sift through the complex details of financial reports and pull out what really matters, the key facts, maybe some surprises, and what it means for you. Today, we're jumping into Hingham Institution for Savings. We've got their second quarter 2025 earnings release right here. Our goal, as always, is to cut through the jargon, find the real story behind the numbers.
Exactly. Think of these earnings reports as, well, a financial checkup for the company. They give you a real window into how they're doing their strategies. And Hingham's latest release, it definitely has some interesting points we need to unpack.
Oh, absolutely. Especially when you glance at those headline numbers. I mean, for the quarter ending June 30th, net income was $9,414,000. Compare that to $4,102,000 for the same time last year.
Yeah.
That's a big jump.
It is. And per share.
Right. Per share, it's $4.32 diluted, up from $1.88 last year. That's, what, a 127.7% increase year over year.
Great.
Attention-grabbing stuff.
Definitely grabs your attention. But, to really understand the bank's core operational strength, we should probably look at their core net income.
Okay. Tell us about that. Why do they present that separately?
Well, they calculate it by excluding the after-tax net gain on their equity security. So both realized gains and unrealized ones. Doing that helps you see how actual banking operations are performing, without the ups and downs of their investment portfolio muddying the waters. It gives a clear picture of the underlying business.
Got it. So stripping out that investment noise, what does the core number look like?
Even more dramatic, actually. Core net income for the quarter was $7,453,000. That's $3.39 per diluted share.
Okay. And last year?
Last year, same quarter, $2,181,000, or just $1 per diluted share. So that core number is up a massive 239.0%.
Wow. Okay. That is staggering. So the core banking business is really driving this.
It certainly looks that way, and other metrics back this up. Annualized return on average equity, ROAE, hit 8.43% this quarter.
Compared
to 3.92% last year. And return on average assets, ROAA, that climbed too, 0.85% this quarter versus 0.38% last year. And even looking at the first 6 months of 2025 overall, diluted net income per share is up 50.1%, and that core diluted figure up 207.0% for the half year. These are pretty significant improvements.
No kidding. Those are really substantial jumps across the board. So what's behind this? What's really driving such impressive performance?
That's the key question, isn't it? How are they pulling this off? I think the answer starts to take shape when we dig into their balance sheet.
Perfect transition. Let's look at the foundations then, the balance sheet. Total assets grew to $4.539 billion at the end of June 2025.
That's about 3.7% annualized growth so far this year, a slight increase, 0.4% from June last year.
And net loans also up to $3.932 billion.
Yeah, and it's interesting where those loans are coming from. Their origination activity is really concentrated.
Where specifically?
Mostly Boston and the Washington, D.C. markets. And they're focusing specifically on stabilized multifamily commercial real estate. So it's not a scattergun approach at all.
Yeah.
Very deliberate.
Right, a focused strategy.
Yeah.
Now, here's something I found really interesting. The deposit side. Retail and commercial deposits were just under $2 billion, $1.998 billion.
Okay.
But check this out. Non-interest-bearing deposits. Those jumped to $437.6 million.
Wow.
Yeah. That's 20.2% annualized growth year to date and up 27.5% from last June. Meanwhile, their interest-bearing deposits actually fell.
That is quite a divergence. Growing non-interest-bearing deposits in this environment, that's significant.
Exactly. So what's the story there? How are they managing to attract essentially free money when everyone else is paying up for deposits?
Well, the report says it reflects their focus on developing and deepening relationships, specifically with commercial and nonprofit customers, both new and existing ones. They mention investing in their specialized deposit group and actively recruiting, particularly as, and this is interesting, they say, respected competitors exit these markets or merge with larger regional banks.
Ah, so they're seizing an opportunity created by market disruption.
Seems like it. And attracting those non-interest-bearing funds that's a huge advantage. It directly lowers their overall cost of funds. It's gold for a bank right now.
Plus, they highlight their stability, right? And that unlimited deposit insurance through Massachusetts DIF. In these uncertain times, maybe that security is a big draw for customers, especially commercial ones.
Absolutely. That kind of assurance, particularly the unlimited coverage in Massachusetts, can be a major differentiator when clients are nervous about where they park their cash. And beyond those customer deposits, they're also managing their wholesale funds, about $2.05 billion there.
How are they approaching that?
Strategically, it seems. They're tweaking the mix to lower their overall cost of funds, and they mention taking advantage of the inverted yield curve. Meaning they're adding some lower rate, longer term liabilities now, locking in cheaper funding for the future. It's active management. Plus, they have a lot of backup liquidity. Over $800 million in borrowing capacity from the FHLB and the Fed, plus $360.6 million in cash. So they seem well positioned there.
Okay, so solid balance sheet management. How does this flow through to shareholder value, book value per share?
That grew too. $204.36 at the end of June. That's up 6.8% from a year ago.
And dividends, always important for bank investors.
They declared $2.52 in dividends per share since June of last year. And this quarter's dividend, $1.63 per share, was their 126th consecutive quarterly payout.
That's incredible consistency. What about special dividends? They used to pay those quite often, didn't they?
They did. Historically, they paid special cash dividends, usually in Q4 in most of the last 30 years. But importantly, they didn't pay one in 2023 or 2024.
So what does that signal?
It signals that future special dividends aren't guaranteed. The bank explicitly says it depends on their capital needs and, crucially, the returns they see from other ways they could use that capital, like making new loans or buying back shares. So they're weighing their options, deciding where capital deployment will generate the best long-term value. It's a dynamic calculation.
Okay, that makes sense. Let's shift gears now to a really critical metric. Net interest margin, or IM. This basically measures their core profitability from lending and borrowing.
The spread, yeah. Crucial for any bank.
And Hingham's IM for Q2 actually increased, went up 16 basis points from the previous quarter to 1.66%.
Up from 1.50% in Q1.
Right. And here's the kicker. This is the 5th consecutive quarter that their NIM has expanded. How are they managing that, especially when the Fed funds rate hasn't changed recently?
That is impressive. 5 straight quarters of NIM expansion points to really active asset liability management. It's not passive. They achieved it, it seems, in 2 main ways, even with the Fed on hold. First, their cost for interest-bearing liabilities went down. Well, retail and commercial deposits repriced lower, plus they strategically added cheaper funding, like those FHLB advances and some broker deposits we mentioned.
Okay, so funding costs came down. What's the other side?
The other side is the yield on their assets went up. They originated new loans at today's higher rates, and existing loans repriced higher too. So they managed to lower their funding costs while increasing what they earn on their assets. That's the recipe for NIA expansion right there. It shows real discipline.
Very skillful management then. But, okay, strong financials are one thing. What about the risks? Let's talk credit quality.
Right. Always essential.
The report shows non-performing assets jumped quite a bit, rose to 0.70% of total assets at June 30th. That's way up from 0.03% at the end of last year.
Yeah, that's a noticeable increase. Non-performing loans also rose to 0.81% of the total loan book.
So what's driving that significant increase? Is it widespread or something specific?
It seems quite specific, actually. The report pins that big jump almost entirely on one single commercial real estate loan. Yeah, a loan with about a $30.6 million balance was placed on non-accrual status.
Why? What happened?
Simple reason. The borrower didn't make the full payment when the loan matured. Now, the details are important here. This loan is secured by a development site in Washington, D.C., planned for a large multifamily project. And crucially, it has guarantees tied to it.
Guarantees? From whom?
From a large national home builder and an affordable housing developer. The bank says they're actively working towards a resolution.
So, while it's a big number, it sounds like there are mitigants in place, and it's contained.
That's the context they provide. They stress that as of June 30th, this was their only non-performing commercial real estate loan. No other CRE loans were delinquent.
Okay, and the other non-performers?
Those are residential owner-occupant loans. So yes, the big CRE loan moved the needle significantly, but it appears isolated for now. It does highlight, though, the ongoing stress in some pockets of CRE, especially development projects. Even careful banks face these risks.
Good context. Let's also touch on efficiency. The efficiency ratio, basically costs relative to revenue, looked much better.
Much better. It dropped to 41.17% for the quarter.
Which compares very favorably to, what was it, last year?
68.57% a year ago. So yeah, a massive improvement.
What does that tell you? Lower is better, right?
Absolutely. A lower ratio means they're spending less to generate each dollar of revenue. It shows that operational leverage they keep mentioning, and it points to their focus on rigorous cost control and continuous operational improvement.
Yeah.
Also, their operating expenses as a percentage of average assets stayed stable. So the efficiency gains seem to be coming from revenue growth and smart management, not just slashing costs everywhere.
Okay, let's bring in the leadership perspective. The chairman, Robert Gum Jr., made an interesting comment. He noted that returns on equity and assets, while much better, are still, and I quote, somewhat lower than our long-term performance expectations.
Yeah, that definitely caught my eye too. Even with these really strong recovery numbers, he's essentially saying we aim higher, sets a high standard.
What does that tell you about their outlook?
Well, he credits the improvement in the core business to exactly what we've discussed. The NIM expanding because assets are repricing up, funding costs are coming down, and that non-interest-bearing deposit growth. But his emphasis is clearly on operational leverage and rigorous cost control being absolutely vital to hit those satisfactory long-term returns. It's about embedding that discipline.
And he also framed their long-term view, saying the business model is built to compound shareholder capital through all economic cycles. He mentioned careful capital allocation, defensive underwriting, and rigorous cost control as the pillars.
That really speaks to their identity, doesn't it?
How so?
Well, remember, Hingham was incorporated way back in 1834. It's one of America's oldest banks. They've seen everything. So when they talk about defensive underwriting and compounding capital through all cycles, it's not just talk. It's likely deeply ingrained from, almost 2 centuries of experience.
So that history informs their approach today, even with operations in places like Boston, Nantucket, D.C., San Francisco.
I think it has to. That long view likely shapes how they approach risk, how they allocate capital. They're not just reacting to the last quarter. They're thinking about resilience and sustainable returns, weighing new loans against dividends or buybacks based on that long-term compounding goal.
Okay, so let's try to wrap this up. Key takeaways for listeners from this deep dive into Hingham's Q2. What stands out?
Well, definitely impressive core earnings growth. That seems undeniable.
Driven by really smart balance sheet management, it seems, especially growing those non-interest-bearing deposits and expanding the net interest margin for 5 straight quarters.
Right, and strong operational efficiency gains, shown by that much lower efficiency ratio.
We do have that flag on credit quality with a single large CRE loan. But, as you said, context is key there.
Yeah.
It seems isolated for now, and they're actively managing it.
Exactly. Overall, it paints a picture of a very well-managed institution navigating current conditions effectively, focusing on core strength, funding advantages, and disciplined risk control.
It's a fascinating case study, isn't it? Showing how strategy and execution can lead to strong results, even in a complex environment.
Absolutely. It really highlights the dynamic factors at play.
So here's something to think about. What does Hingham's success in growing those free deposits and their ability to keep expanding NIM tell you about how banks might be adapting or needing to adapt today, especially when faced with curveballs like that non-performing loan? And maybe also consider, how does a bank's history with special dividends, including pausing them, reflect its real-time thinking about the best way to use capital for the future? Lots to chew on there.